Ever feel like you're just wading through endless financial news?
Yeah.
Reports, analyst notes, trying to figure out what really matters.
Oh, absolutely. It's the information overload sometimes. Finding the actual insight can be tough.
Exactly. It feels like trying to build something complex without the key pieces. And that's really why we do the deep dive. We're not just going to recap the news you've already seen. Our mission is to really dig into the sources you provide, cut through that noise, and pull out the knowledge that counts. Find those aha moments.
Giving you the signal, not just more data.
Precisely. And today, we are diving deep into 3BBIF. That's the 3BB Internet Infrastructure Fund. Our mission, unpack their Q2 2025 performance, look closely at the dividend news, which is pretty significant, and figure out what the latest numbers like PE, EPS, and dividend yield are actually telling us about where things might be headed.
Sounds good. A lot to unpack there.
Yeah. So just for a quick snapshot before we jump in, as of August 6, 2025, the share price was 6.15 BAT. It was up slightly on the day, about 0.82%. Trading volume was pretty active, actually. Over 5 million shares traded, worth around 31 million BAT.
Decent activity.
And just for context, the 52-week range has been between 5 BAT and 6.75 BAT. So that kind of sets the scene for our discussion. All right, let's get into it. 3BBIF's Q2 2025 performance. Now, on the surface, revenue might look, well, a bit flat, maybe.
Yeah, that's right. Total revenue came in at about 1.88 billion BAT, and that was down just fractionally, like 0.07% year-over-year, 0.04% quarter-over-quarter. Barely moved.
And most of that, nearly 1.86 billion, that was the stable income from leasing out their fiber optic network, right?
Exactly. That core lease income held steady. Interest income was down a bit, but that's mostly due to lower rates.
Okay, so stable revenue. But here's where it gets interesting, isn't it? The net investment profit, that number jumped.
It really did. Jumped to 1.607 billion BAT. That's up 7.5% compared to last year and over 14% just from the previous quarter. A big
A
move.
huge move. And the net asset value, the NAV.
Also looking strong. As of June 30th, it was at 68.5 billion BAT baht, roughly. That works out to 8.5676 BAT per unit.
So stable revenue but soaring profit. What gives? How they manage that?
Well, what's fascinating here, and this is the key, is the cost side of the equation. They managed that profit surge because expenses dropped dramatically.
Dramatically how?
Total expenses were slashed down to just 273.3 million BAT. Now compare that, it's down almost 30% year-over-year and over 42% quarter-over-quarter. Massive reduction.
Wow. And what was driving that reduction? Was it one specific thing?
It absolutely was. The main driver, the core reason, was a huge drop in financial costs. We're talking down nearly 57% year-over-year and over 68% quarter-over-quarter. Financial costs fell to just 92.4 million BAT.
Okay, 68% quarter-over-quarter reduction in finance costs. That's not just trimming the edges. That points to something major happening, right?
Exactly. It points directly, loudly to that strategic debt restructuring they did. We definitely need to talk more about that. It fundamentally changed their cost structure.
Right. But before we get to the restructuring, there was one other big number in the Q2 results that gained from the fair value change of investments. Over 1.3 billion BAT.
Yes, that's important too. A very significant gain.
What exactly is that? Is that cash in the door or more like an accounting thing? How should we think about that huge number? It boosted net assets from operations by like over 1,000%.
That's a really crucial distinction to make. That 1.3 billion gain isn't cash flow in the way, say, lease income is. It's primarily an accounting adjustment.
Okay.
It comes from a professional reevaluation of their main asset, the fiber optic network itself. Think of it like getting your house reappraised and finding out it's worth a lot more.
Got it. So it reflects the value of what they own has gone up, but it's not money they can immediately spend or distribute.
Pretty much, yes. It signals that their core infrastructure assets are seen as more valuable, which is definitely positive for the fund's overall health, its NAV, and its long-term stability. It boosts the balance sheet. And, it might improve their ability to leverage those assets down the road, but no, not immediate cash.
Okay, that clarifies things. So improved asset value on paper and drastically lower actual cash expenses, specifically those finance costs. Let's dig into why those costs plummeted. What's the story behind that?
This is where it gets really interesting. It all goes back to that strategic debt restructuring they pulled off earlier in the year.
Right, back in Q1 2025, February, I think.
That's the one. It wasn't just a simple refinance. It was a pretty smart move.
So what exactly did they do?
Okay, so 3BBIF borrowed 5.45 billion baht jet from SMBC, that's Sumitomo Mitsui Banking Corporation.
Okay.
And they used that money to pay back half of the debt they owed to Bangkok Bank, BBL.
Paying off one loan with another, essentially. But why was that strategic?
Because the terms were much better. And critically, doing this allowed them to release a huge chunk of their assets, 279,000 core kilometers of fiber optic lines that were previously held as collateral by BBL.
Ah, so it freed up assets, giving them more flexibility.
Exactly, more operational flexibility. And it's worth mentioning ADVNC, the big telecom player, apparently helped 3BBIF negotiate these much better terms. It was a fundamental shift in their debt structure.
Okay, so connecting this back to the numbers. How did this restructuring translate into those massive cost savings we saw?
Well, the impact was immediate and profound. The effective interest rate 3BBIF was paying just cratered. It went from a pretty high 6.9% down to an average of around 3.6% to 3.7%.
Well, cut almost in half.
Pretty much.
That was-
Specifically, the new SMBC loan is at 3.2%, and the remaining BBL debt is now at 4.0%. So that average comes out much, much lower.
And what does that mean in terms of actual money saved?
Projections are that this move will save the fund somewhere between 200 and 300 million baht in interest payments every single year.
2 to 300 billion baht.
Yeah.
That's serious cash flow freed up.
Absolutely. Money that was going to service debt can now potentially flow elsewhere. And here's another interesting point. That new average cost of debt, around 3.7%, is actually better than a Q competitor like DIF. DIF's effective financial cost is around 5.5%.
So this gives 3BBIF a competitive advantage now. Lower cost structure.
Definitely. Lower costs mean better margins, better potential profitability. The aha moment here for you as an investor is understanding how this technical move restructuring debt directly unlocks earnings potential and clears the path for more sustainable, potentially higher dividend payouts. It's huge for the fund's future health.
Okay, that makes perfect sense. Lower costs, stronger finances,
Right.
which brings us directly to dividends, because that's often the main draw for these infrastructure funds, right?
Absolutely. Steady income is key.
But 3BBIF had that issue, didn't they? At the end of Q1, they were carrying that accumulated loss of about 1.6 billion baht.
Yeah,
And you can't usually pay dividends when you have accumulated losses.
that's right. That was the hurdle they needed to clear.
Now, there were some forecasts floating around. L8 Securities, for instance, thought maybe they could clear that loss in Q2 or Q3, perhaps paving the way for dividends to restart in Q4 of this year.
Yeah, the thinking was that their typical quarterly profits, around 1.3 billion baht, could eat away at that loss relatively quickly.
Okay, drum roll, please. What's the actual news?
Well, the news is even better than those forecasts. 3BBIF has already announced a dividend payout, their 35th payout for Q2 2025 operations.
Already. So they cleared the loss and are paying out for Q2. That's fantastic news for unit holders.
It really is. It signals a strong turnaround.
So what are the details? How much is the dividend?
The dividend per unit is 0.15455 baht.
0.15455 baht per unit.
Okay, and the source is cited as Q2 2025 operations and accumulated profit. So they definitely cleared that hurdle. The total payout will be about 1.236 billion baht.
Got it. And the key dates for investors.
Mark your calendars. The record date is August 20th, 2025, and the payment date is September 3rd, 2025.
Okay, August 20th record date, September 3rd payment. Great news. Now, does this signal a return to regular quarterly payments? What's the policy?
That's an important point. The fund's policy actually mandates quarterly payments once those accumulated losses are gone. So yes, this Q2 dividend is a very strong indicator that they're back on track for regular distributions.
Good to know. But there was something else. A tax change.
Ah, yes. Very important for you to be aware of this. That 10-year income tax exemption that applied to dividends from funds like this, it ended in 2024. Meaning, starting from this year, 2025, dividends paid out by 3BBIF will be subject to a 10% withholding tax.
Okay, so while the dividend is back, the net amount received will be slightly lower due to that new tax. Crucial point for planning.
Exactly. Definitely factor that 10% tax into your calculations.
All right, so we've seen the improved Q2 profit, understood the game-changing debt restructuring, and celebrated the return of dividends. Now let's talk valuation. What are the key metrics telling us? PE, EPS, dividend yield? What do the current numbers look like?
Okay, let's break down those numbers as of August 6th. The reported price-to-earnings ratio, or PE, was 8.6716.
8.7, basically. Okay.
Earnings per share, EPS, reported at 4.28 BAT.
4.28 BAT.
And the current dividend yield, based on recent payouts, was listed at 7.90%.
Okay, 7.9% yield. Those are the snapshot numbers. But given everything we've just discussed, especially the lower costs and dividend restart, how should we interpret these? Are they backward-looking?
That's the right question. The real story emerges when you look at the forward-looking projections, especially for the yield. That current 7.9% doesn't fully reflect the impact of the restructuring yet.
So what are the projections saying?
Well, analysts are significantly more optimistic now. Capricorn Securities, for example, they're forecasting a dividend yield of 10.6% for both 2025 and 2026.
Wow, 10.6%. That's a big jump from 7.9%.
It is. They estimate a total payout of about 0.574 BAT per unit for the full year 2025. And they're not alone. Maybank and Krungsri are also projecting yields somewhere around the 11% mark.
So multiple brokers seeing potential for double-digit yields going forward.
That's the consensus among those three, yes. It really highlights how impactful that debt reduction is expected to be on distributable income.
And have these brokers changed their recommendations, their target prices?
They have. All three you mentioned, Capricorn, Maybank, Krungsri, have upgraded their recommendation on 3BBIF to buy.
All calling it a buy now.
Right.
What about target prices? Are they aligned?
There's a bit of a range there, which is normal. Maybank has a target of 6.0 baht. Capricorn is slightly higher at 6.30 baht, and Krungsri is the most bullish with a target of 7.8 baht.
Okay, a range from 6.0 to 7.80. What's the underlying reason they give for these upgrades and optimistic targets?
It boils down to a few core things we've discussed. Improved fund liquidity, basically, better cash flow, a lower weighted average cost of capital, or WACC.
WACC, that's the overall cost of their funding, debt, and equity combined, right?
Exactly. A lower WACC means it's cheaper for them to finance their operations, which boosts profitability. And of course, the big one, that significantly lower cost of debt thanks to the restructuring.
So it all connects back. That seemingly technical debt deal translates directly into analyst upgrades and higher expected returns for investors.
Precisely. It shows how understanding the why behind the numbers is so important. It's not just about the current yield, it's about the sustainability and growth potential unlocked by these strategic moves.
That's a really powerful illustration. So zooming out a bit, what does this mean for you, the listener, thinking about where 3BBIF fits in an investment strategy? Why consider these big infrastructure funds in the first place?
Well, generally, large infrastructure funds like 3BBIF are seen as relatively safe assets. They own essential infrastructure, in this case, fiber optic networks, often with long-term contracts, providing predictable revenue streams.
Predictable income is definitely appealing.
And they can be particularly attractive when interest rates are expected to fall or are already low.
Why is that?
Because lower interest rates mean lower borrowing costs for the fund, just like we saw with 3BBIF's restructuring. When their financing gets cheaper, more of the revenue can potentially flow through to become profit and ultimately dividends for you. It enhances their return potential.
Like refinancing your mortgage at a lower rate frees up cash.
Exactly the same principle.
No.
And for 3BBIF specifically, that stability is underpinned by those very long-term leases on their fiber assets. They run all the way to 2081. That's still 13 years left. That's a lot of visibility on future income.
13 years of contracted income provides a solid foundation. Now, we mentioned some brokers are very positive, but not everyone is maybe quite as bullish. LH Securities, for instance.
Right. It's important to note that while the outlook has improved significantly, some analysts, like LH, might maintain a more cautious stance. This could be due to factors like past market volatility or just a general focus on strict risk management. It's not necessarily negative, just a reminder to always consider the potential risks alongside the potential rewards. A balanced view is always smart.
Good point. So if you're looking for dividend income, how might 3BBIF compare to, say, other traditional dividend payers like big banks or maybe PTT?
That's a great comparison to make. Banks and companies like PTT can offer diversification and have track records of stable payouts, often tied to broader economic cycles. 3BBIF offers something slightly different.
How so?
It's a pure-play infrastructure investment. Its income is directly tied to those long-term leases for essential digital infrastructure, which might be less sensitive to some economic fluctuations compared to, say, banking, or energy. And now, with its restructured, lower debt costs, its potential yield and stability profile looks arguably stronger, especially if you prioritize predictable cash flow from long-term contracts.
So different risk-reward profiles, different kinds of stability, depends on what you're looking for in your portfolio.
Absolutely. What this deep dive really highlights, I think, is that 3BBIF has fundamentally improved its financial health and its ability to generate returns. The underlying assets are strong, the contracts are long-term, and the debt burden is now much lighter. It makes it a compelling story for income investors to consider.
Definitely a compelling story. So let's recap our journey today. We started by unpacking 3BBIF's Q2 performance stable revenue, but soaring profits thanks to cost cuts. We then dug into the pivotal debt restructuring that made those cuts possible.
Right, which directly led to the fantastic news of the dividend restart for Q2, clearing that accumulated loss hurdle ahead of some expectations.
And finally, we looked at how this translates into valuation, a current yield around 7.9%, but analysts projecting significantly higher yields, potentially over 10% going forward, leading to broker upgrades.
It really shows how interconnected everything is. So here's something to think about. Consider how these seemingly complex financial moves, restructuring debt, revaluing assets, aren't just abstract accounting exercises. They fundamentally change a fund's power to generate real cash flow. And ultimately, they reshape its ability to deliver returns directly into your pocket. What does this deep dive really tell you about the importance of looking beyond just the headlines and digging into the why behind the numbers?
That's a great thought to leave with. It really is about connecting those dots, understanding the mechanics behind the results. We hope this exploration of 3BBI's turnaround empowers you to keep digging, keep asking questions, and keep connecting those dots in your own financial journey. Thanks for joining us on the Deep Dive.